Hey everybody, and welcome back to another video. This is how to invest. I just wanted to start this off. Haven't made a video in a couple days, so let's hop right into it. If we're looking at the market today, kind of at the general indexes, doesn't really seem, or the general indices doesn't really seem too bad. Check the S&P 500 down less than 0.1%. Dow Jones up even. The Nasdaq's down 0.6%. But holy guacamole, you gotta be smashing my avocados. Look at the Russell 2000 here, down almost 3%. And then the VIX up 10%. If you don't know what the VIX is, it's the volatility index, which is not always a bad thing, but it just means that prices are moving at a rapid rate. So what I wanted to do in this video was show you 10 stocks that are down over 5%. So we'll start with the first one, and these are going in order from highest percentage to the lowest. So the first one is SunPower Corporation, ticker symbol SPWR. It's down over 10% today at 11.04. If you don't know what SunPower is, it is a solar energy play. So if we look here, the market capitalization is just under $5 billion and a pretty attractive PE ratio. I haven't quite looked into the company, but if you're looking at a cheap versus overvalued price, you may consider this to be a cheaper stock. If we look here what the analysts are saying, it says it's almost at fair value and a pretty bearish one-year estimate by the Yahoo forecast of only $31. So it might have gotten a little ahead of its times, and it might just have some horizontal consolidation for a period of time. If you wanted to look into this stock further, if you wanted to buy it, I would definitely suggest to do further research. Of course, this is not a financial advisor or anything. This is just for entertainment or research purposes. And I'd highly advise you to do some more research before purchasing or buying puts or calls or shorts. So this next one is another solar energy play. This one is called Sunrun. A little bit more expensive, about double the market cap at $10.5 billion, and they are not currently making money, so they do not have a price to earnings ratio, so they're not earning anything. They actually have a negative earnings per share of 1.24. If we times that by the amount of shares, we can get just over, what is that, a quarter, just over 250 million in net losses per year, which is not too good to say the least. Oh, we lost it here. We'll go back. Here we go. But the analysts are a little bit more bullish on this stock because they think they are growing at a rapid rate. Not a rapid rate, but compared to SunPower, they're growing more. Right now, they say that it's currently overvalued, but the one-year target could be $81. So if this were to drop any further, could be a pretty attractive price if you are looking at a one-year return based off this. Of course, do your own research. This is I would never trust any targets put on any of the brokerage accounts just because they could be either way too bullish or way too bearish, and you can make a lot of money based off of what other people are thinking. That's kind of the whole premises of how the market is. You play one way when most other people are playing another, and that's where you really make the bulk of your money. So if we get into the next one, is Plug Power. This is in the green hydrogen play. And it has come down considerably in the past 6 months. It was at a peak of 73, so down over 50%. On the day, it's down almost 10% at 9.55, and it's at a market capitalization which is approaching pretty attractive levels. $18 billion. If this gets closer to 10, say under 15, I might personally be doing some more research and considering whether I have to buy, because I do not have any green hydrogen plays and I would like some exposure. And this one has a quite the good PR because I've at least heard about it. I haven't heard about any other green hydrogen plays They are currently losing quite a bit of money too. If we look at 1.5 earnings per share negative, and we times that out by the shares, it is, wow, so over $1 billion in losses, or almost probably about 800 million in losses, which is quite substantial to say the least. They also do not have a price to earnings ratio since they are not earning any money. Now, that doesn't mean that they are not making any money. That just means that on the bottom line that they have more costs than that they're making on an EBITDA adjusted basis. More research pretty intriguing. If we go to the next one, this is stock number 14. The Trade Desk is a huge market capitalization. Maybe one other, probably the next one. But this one dropped over 8% today, almost 9%, which is quite substantial for such a big company. They were about $30 billion market cap before the day. Now they're only at 29, which is still quite up there for considering most companies in the world. They have a huge price to earnings ratio of 123. To give you just some comparisons, the average right now for the Russell 2000, I think, would be in the 20s to maybe high 20s, maybe 27 at the most, but we're at an extremely high level to begin with. It should be somewhere in the teens for most markets, but we are in a kind of inflated market since we have heightened liquidation and a lot of people are entering the market. Just a lot of different nuances. If we look at the 1-year target, it is $857, which is not too great of a return if you're looking at to invest for a year. I think this one, if you're looking at it, it's more of a long-term play, kind of hoping that they are going to grow substantially. If you don't know, they are kind of an advertising software play. They allow people to buy ads and then place them accordingly where they fit with the customers and their target group. And the analysts on Yahoo Finance do say it's overvalued right now. So if it were to come down even maybe another 10%, it could start being attractive to some people. So if you're interested, check this out. The next stock is DraftKings. So this stock I am actually personally pretty bullish on, just off the basis that there's so much room to grow in the industry. I think this and a couple other industries throughout the United States where they aren't fully legal throughout the United States but are working in select states just have huge upside compared to the rest of most companies. And this is no different. So if we get into it, it is looking at a $23 billion market cap, which is I think might be the biggest for online betting, like on mobile. So they are pretty up there. $30 billion is a huge number, nothing to scoff at. They are not currently making money on a price to earnings ratio, and they have no info on their earnings per share. I think this would have something to do that they're more of a newer company. If we look at the 1-year chart, yeah, they only went public on September 19th. So they have not really gotten in their financials very efficiently, or if they are, because normally it would either say negative or it would give you a positive number, because there's always going to be some earnings per share. But if we look at the analyst numbers for the 1-year trajectory, it says $72, which I think would be even pretty bare considering if any other states legalize gambling, and right now they're considering it overvalued. So if you want to do more research about this stock, I would highly suggest it. The next stock is Churchill Capital. This one is going to be merging with Lucid Motors. So I know there's a lot of hype around that, and there has been, or it's kind of fallen off if we look at the charts in the past 6 months. So it kind of peaked on February 18th, of the year and has dropped quite substantially since then. So if we look, the market capitalization still isn't right because they have yet to make the merger with Lucid, and once that happens, there's going to be, I think, over 1 billion shares outstanding. So you have to times that by the share price, and it's going to be over $30 billion. The evaluation is coming down quite substantially as it does begin to fall, but it is still quite inflated, in my opinion, just for the stage of the company and where they're at, considering that they only have prototypes and there are no cars on the road. And even the analysts will say that it's overvalued right now, even though it's come down over 40% or over 60%. They do not have any earnings. This is a pre-revenue company even, so they're not even making any money right now. So it's literally just throwing fire into a hole. Now, the allure of this stock is what they will become in the future, and they saw Tesla do it. So who knows? People might want to try and jump the train early and just have a vote of confidence that this stock will. Just a value or stock will execute on their plans and become competitive in the automotive market. So if you are interested in this stock, I would definitely do some more research before buying and maybe hold out for a little bit, wait to see some product or it fall quite substantially, make a big move. Even at the 15 range could even be considered not the best returns on your just a 1 year outlook. If we get into the next one, this is called Jumia Technologies. This is not a American stock, just to forewarn you. This is based out of Africa. This is an e-commerce play that fell 7.44%. This is trying to really get consumer products to the citizens of Africa. No matter the country, they're trying to expand, which they are rapidly, which this company, like most that are expanding rapidly, is not earning any money. If we look at the earnings per share, it is really, really bad at negative 2.39. If we times that out by the shares, negative 2.4 times 100 million, so over 240 million in losses. If we look at the fair value right now, analysts will say it's overvalued, which I might slightly disagree with. I think that this valuation is becoming very, very attractive. I think that anywhere around the $3 billion, or maybe if you could get this under, is starting to be very intriguing to me, just because the massive potential. I think everyone knows that the size of Africa is quite huge, and they are a really, really, really fast-growing markets in most cases. Now, there does need to be some infrastructure, and some is an understatement, that needs to be built up, because not exactly every even country where they're working off of are roads or airports or delivery factories. So they are kind of stretched at supplies and supply chain, but this is something that they are drastically looking to overcome. They do a lot of offerings to try and offset that, which a lot of people do not like, but in my opinion, I think that offerings can be a great way to really buy the dip on long-term companies that you believe in. If they do a lot of offerings, you're just getting more and more shares at a cheaper price, even though they are being diluted each time, but you should be buying more and more each time as you are able to accumulate more money as they give out each offering. So if you're interested in an e-commerce play that is in Africa, check out Jumia, ticker symbol JMIA. The next one is back to America. This is actually kind of a semi-global company too that will be, because they are partnered with Magna, which produces, I'm pretty sure, Audi and a couple other German car makers. So this stock fell 6.25% today, down to $16. This stock had been making quite an upward move in the past month. It was just about this levels at February 23rd and almost quickly doubled in a couple days. In 3 days, went up to $28. And I'm not quite sure what the hype was at that period, but this stock does have quite a bit of upside if you are looking at the EV market and you are bullish on it. Right now, the market capitalization is $4.5 billion. They right now have, I think they have one car on the road. Maybe they are in pre-order phase. I'm not quite sure. This is where you would need to do more research, but they have a car called the Ocean. If you want to do more research, this is what it looks like. Pretty good looking car. It's an SUV, which I know most countries are trying to buy more of. They're kind of going away from the sedan model because families are growing at a rapid rate in most areas of the world, not every, including Japan and the United States and some other mature countries. So if we look here, it is currently listed as overvalued by the analyst, but there is a 1-year price target of $28.50, which is exactly what it peaked out at just a month ago. So not a bad year target. You could almost double your money, and considering that the EV market isn't really going to ramp up too much in 2022, it's more of a multi-year outlook, more towards 2025 and 2030 in my opinion. This will be a slow chug. That is not a bad return. So if you were a long-term investor, that would be pretty good because it would allow you to buy more and more shares over a long period of time and slowly buy in so you can build your position. If you are bullish on this company and believe that it will be worth much, much more than this in the future, because if they're partnered with Magna, they have just endless possibilities that they could produce. So if you want to look more into it, ticker symbol is FSR. The next one has been on quite the tear recently. If you have been watching the stock market, you guys know Upstart. It is, if we look here, almost tripled. Yeah, it's tripled since the beginning of March 8th. It was a $46 stock and went up to $164, so almost quadrupled, and has come down a little bit, pulled back, and then went up again. So it's down at the 120 range. Of course, it would be more attractive if it reached these 112 ranges from the other days, but this is a rapidly growing company, so I'm not quite sure that it might. If we start off with the market capitalization, it's 9.9 billion, so 10 billion, and this is a pre-earnings company. As you can see here, there is no earnings per share or price to earnings ratio. Right now, analysts are considering this overvalued, so there might be more room to fall for this because it had quite a big jump, and it might have overshot its values and might need to either sideways consolidate or even fall quite a bit more. The 1-year target is actually below where it's at right now, so if you are looking to invest in this company, I would have to be very, very bullish and maybe know something that these analysts are not looking at. If you wanted to deep dive into their earnings reports or their yearly reports, that might be a good idea to try and find just some bullish points on this company. But if not, that's all right. We'll go to the next stock. And this is the last one for the video. This one I actually am personally invested in and has been for quite a bit. If we look, it's been on quite a tear for the year chart. It is up over 10x, and this company is down over 5% today. Ticker symbol GRWG. Now this plays in the adult flower industry. They do not sell any of it. They are the wholesalers of equipment that you will need to produce any amount of adult flowers. So they have literally anything. If you want to look at their website, you can just look up their name into Google website, and it'll pop right up. It is kind of like a Home Depot or a Lowe's for hydroponics and different growing equipment, even cloning equipment and post-production equipment. So anything you need to do to extract from the plant or along those lines, if you know what I'm talking about. If not, you can do more research on this company. If we want to get into the financials here, they have a current market capitalization of $2.28 billion, and their price to earnings ratio is sky high at 378. Like I said earlier, kind of an average range right now would be 20 to 25, which is high for a yearly average considering the past decades, unless we're in bubble territory for earnings. But nonetheless, it is good for a company in this industry to be earning money at this stage because they are a fairly new company, and most do not focus on profitability, which I think is a big mistake because that is exactly what Wall Street focuses on. They want to see if you are making money and you are doing it consistently. They want a positive cash flow and lots of it. The more you have, probably the more your stock will go because you can never have enough money. If we look here, the earnings per share is 0.1. If you want to look and times that out by the shares, you can, but it's not going to be very much. But it is good that they're earning money on the bottom line nonetheless. If we look here, the 1 year target is $56, which is not very attractive at all if you were looking to invest just for a 1 year outlook. But I think this company, like I said about an earlier stock such as DraftKings, this is an extremely bullish field just because only certain states are legalized right now, and there are more than double the amount that could legalize and have potential for revenue and profits, and to expand into, to grow more stores and to ship more online product. I think their e-commerce products would be a very long-term positive for this company, considering that they do supply to Amazon. A lot of people will think, oh, well, what are they doing over Amazon? Well, they're getting these these products to Amazon, so I mean they must be doing something right. If Amazon has to be buying them. If you want to do more research on this, I highly suggest it. Like I said, it's in a pretty bullish field, and I hope you liked the video. If I forgot to mention in the beginning, there will be at the start of or in the description section, if you are not currently signed up for either of these two brokerages, you can get one free stock for Robinhood in my link in the description, or if you sign up for Webull, you will get two after you deposit $100, and they will be up to $1,800. So if you're not, I highly suggest it. You can just take the money right out of Webull after you do deposit it. You don't even have to buy it on stocks, and then just hold the stock because in my case, that they give you pretty good stocks. I got NEO in the single digits a couple times. I had a couple of those. So I got those to over 10x from Robinhood. They were giving those away for dirt cheap. If you, I got a couple of Viacom CBS, and I got those in the single digits, and I held those. And I sold those just before it popped, and those held quite a bit of, I think they almost 10x when I held them. And they were just free stocks. I got 3 of them. So you never know what you can make from these. And like I said, that's not even the most you can make. You can make up to $1,800. So definitely check it out if you haven't. And subscribe, like the video. Have a good one.